For the first 2 years of my trading career, I thought that I was smarter than the markets. I would see a stock crashing and think, well, this has to be the bottom. This is going to be the best place to buy, and this is going to make me an absolute millionaire. And then I would see a stock ripping higher. I would think it's way too overextended. It's overbought. This thing is going to reverse, and I'm going to make a ton of money on this. I was trying to learn to be a hero and catch massive wins, to be right, to feed my ego, trying to predict every single top, every single bottom, and try to outsmart everybody. And guess what happened? I got absolutely destroyed. Over and over again, the market proved me wrong. The stocks that I thought were too high kept going higher, and the stocks that I thought were cheap kept getting cheaper. I couldn't figure out what I was doing wrong. Then one day, everything actually started to click. I stopped trying to predict where the market was going, and I was actually just following what the market was doing. This sounds simple, almost too simple, but that one single shift led me to be able to become a consistently profitable trader. When I finally understood how trends worked, what stage the market was in, and how to be able to ride those trends for momentum, that's when everything in my trading finally changed and I became consistent. Now, this is episode 3 of the swing trading series. Quick little recap of everything we covered in episode 1 and 2. Episode 1, we laid the foundation, and episode 2, we covered how to read price action and understand the market structure. Now, in episode 3, we're going deeper. We're talking about moving averages, market structure, and the trend of the market. And honestly, this concept probably has made me the most money over my career. I'm going to show you exactly how I use the 8, 21, and 50 exponential moving averages to be able to time the trends in the market and ride the momentum instead of fighting the tape. I'm going to break down the 4 stages of the market and why I only trade stocks in this one specific stage. And I'm going to explain why trend following beats prediction every single time. This is where swing trading really starts to click. This is where you stop overcomplicating things and see the markets for what they really are. So let's get right into it. You've been reading the entire market the wrong way. Now, the good thing is in this video, you'll learn exactly how to read the markets the correct way and how to understand how the markets actually move, because there's a difference between just a move up and a move down. And it's not how you think. Markets don't go straight up and they don't go straight down. They move in a very manufactured way that we can actually take advantage of. The first and most important thing I want every single person to do is turn on the moving averages on their charts. You're going to turn on the 8, 21, and 50 EMAs. What these moving averages are going to do is they're basically going to tell us what the trend of a stock we're looking at is. So for example, you could see when we're looking at this chart right here, every single time a stock is under all 3 moving averages, it is in a very big downtrend, and we are likely going to look to want to trade the downside. So we want to play the downside moves of that leg. Now, whenever the market is above the moving averages and it starts to reclaim all the moving averages like this, we're clearly in a big uptrend, and you could see the market continues to make new highs, make higher lows, and push higher. This is called a trend. So the moving averages work beautifully on every single time frame, but the most important time frame is the daily time frame. We want to know what the daily trend is because we're usually looking to trade over a week, 2 weeks, or even potentially a month. Using the 1 week trend is good as well because it gives us an idea of the larger, broader kind of trend in the market. And what you usually want to do is combine the trends together. If you could look for a daily trend that's also in a weekly trend, now you know that there's that time frame continuity and you have a lot of continuation on the bigger time frames combined. Now, once we understand that the market doesn't just move up or down, it moves within these trends, we can even look a little bit deeper into how these trends kind of look like and how we can take advantage of the formation of the market structure. So the markets don't just go straight down. They don't also go straight up, right? When I drew this out, it didn't line up with the way that the market moved. They move in what I like to call staircases. So this looks something like this. It'll make a big move up like this. It'll start going sideways and it will build what I like to call a staircase or a consolidation pattern. And the reason why stocks do this is because they need to build up the demand again to make a big move up. They can't just go straight up because not everyone's just going to continue to buy when prices are higher. And markets are dynamic. They price things based on supply and demand. Sometimes it's going to be in excess of supply, and sometimes the stock needs more time to consolidate, to wait for the moving averages, to wait for new buyers to come in. And this is why stocks don't just go straight up. It'll go sideways, build a staircase, and then it will go again. And these are called our impulse legs. And then obviously the stock will go sideways again, and then it will go higher, sideways again. And then eventually it kind of runs out of momentum and it starts to change the trend. And the thing is, when it changes its trend, it's not just going straight down like this, right? It's not cratering down. It's also moving in staircases. So it'll build a little bit of a bear flag and then go lower, a little bit of a bear flag and then go lower until obviously it changes its trend. And then it continues to do the same thing over and over and over again. And it uses the moving averages as a guide to where it's going to go. And whenever the stock breaks under the moving averages like this, now it's using it as resistance. When it reclaims, now it's using it as support and to kind of support the next leg up on the move. Now, once we understand this concept and how the market actually moves, we can go back and actually look at this playing out in real time here on the S&P. So you can see we had a pretty steep move down. We didn't just go straight down the whole time. We made a move down. We built a staircase right here, and then we made a move down. We built a staircase and then we made a move down until obviously the trend changed. The market got above the moving averages and now an uptrend began. And here you could see we have the same exact thing. We made a big move up off the lows. We built a staircase pattern. We went up. Staircase pattern went up. Staircase pattern went up. Staircase pattern went up until obviously the trend ended up kind of changing here and we started to build a little bit of a bigger base. Now, keep in mind, this is why timeframes are so important because now there's so much consolidation that's happening on the daily timeframe. If you zoom out on the weekly timeframe, you could see what we're setting up, right? So we had a very big move up on the weekly timeframe, and now we're just setting up in that staircase because again, stocks can't just go straight up. You could see here on the weekly timeframe on the S&P, we made a big move up, and then we had the staircase, big move up, staircase, big move up, staircase, right? And then we continue to move higher and higher. And even this move right here on the weekly timeframe is a bigger staircase on the larger timeframes. And this is why using the bigger timeframes is so important because you can get more context on what is happening on the actual stock. Now, our goal in understanding these staircases is actually being able to trade them and understanding when the best time to trade a stock is. The best time to trade a stock is not when the stock is just consolidating in that staircase and not moving because you're just getting chopped up. You actually want to trade a market or a stock whenever it's breaking out of its range and making a massive move. For this example, you could see we have a massive move off the lows and then we have our staircase that forms right here. You actually want to start trading the stock when it starts to make its next leg up because look at how big of a move you just captured, about a 30% return, while right here you were just kind of chopping the whole time and the opportunity cost was very, very low. And then you can see the same thing ends up happening. The stock makes a move up, builds a staircase, another massive leg up. And then right here, you can see you catch another 35% move. And then you have another staircase that sets up, move up, staircase, move up, so on and so forth until the trend changes. Now, your goal the whole time is to be able to ride this trend. You never want to just get in and out of a stock the same day. You want to do something that's called swing trading, meaning you're holding the position overnight. You're holding it for a longer period of time because then you take advantage of the way the market moves. The market does not move all in one day. You don't just get a massive 100% move in one day, but in a few months, you can catch a 500% move. You can catch a 1000% move because the market moves over months. And you want to be able to ride the trend until the trend breaks. And this is why I use the moving averages, because as long as stocks hold their key moving averages, you can continue to get really nice results using those moving averages. And you know the trend is continuing to hold. Now, if the trend breaks and the market breaks below the moving averages, now you know that there is a change in trend. You can actually play a reversal or you can look to exit the position. Now, remember, that was the daily chart on the ticker RKLB. But now if we go to the weekly chart, we can see there's a little bit of a difference between the moving averages because they take a little bit more time to set up. Even though we had a ton of really nice staircases here, you could see on the weekly time frame, we have a little bit of a different look. So we had the big move up here. We built our staircase, big move up, staircase, big move up, staircase, and now we're setting up another staircase on the stock. And you could see that this is all happening also on the weekly as well as the daily time frame. Whenever the weekly time frame starts to become a little bit extended, that is usually when you have bigger pullbacks like this on the weekly time frame to the bigger levels of support. Now, in a strong trend, one of the most important moving averages is going to be the 8 EMA. That's going to be the one that's closest to price. Then you have the 21, then the 50. How I like to think about it is whenever there's a lot of momentum in a stock, it'll never break under the 8 EMA. So right here, you can see the stock tags the 8 EMA, makes a big move up, tags the 8 EMA, makes a big move up. When a stock starts to lose the 8 EMA, that is when the momentum starts to roll over a little bit, and it tells you the stock might need a little bit more time to consolidate, and that's where you have the 21 EMA come up. You want to think about moving averages and a trend as ammunition coming up. The moving averages are basically going to be the average price for a specific day. So for example, over the last 21 days, what is the average price? That's going to be the 21 exponential moving average, and it's going to tell you where buyers are, because institutions, they want to buy at the average price. They want to be able to get in and out at the average price. They don't want to overpay, and they also don't want to get in a little bit too cheap because they don't know if there's going to be a trend within that stock. They want to buy near the average price, and that's why it creates such a strong trend for you to trade. Now, when the 21 EMA starts to kind of lose, that is when you have the last line of defense, and that's going to be the 50 EMA. The 50 EMA is usually the last line of defense, because if a stock breaks the 50 EMA on the daily or weekly time frame, usually you're going to see a lot more chop, a lot more consolidation until a new trend begins. And this is something you do not want to trade. Remember, we do not want to trade the staircase. We want to trade the leg that comes out of the staircase. So for this example, you can see this stock is starting to set up in a pattern. Now, patterns happen in volume, they happen in candlesticks, and they also happen in the market as a market structure. You want to start taking note of these patterns that happen in the market. The pattern itself is not that important. A lot of people like to stress over a bull flag. They like to stress over an inverse head and shoulder, or cup and handle. There's so many different patterns in the market. The most important thing to understand is a pattern just means that a stock is tightening and it's consolidating. And you want to think about price as a spring. It gets super coiled until it finally releases and makes a really, really big move. And that's exactly what we want. We want consolidation. We want tightness, so that could lead to an expansion move out of that tightness. And that's where the really big moves in the market happen. Again, we don't want to be trading and sitting in this stock here for months while it's doing absolutely nothing. We want to be trading it here right as it starts to move and make its massive moves, because that's called opportunity cost. Being able to sit in a stock that is making a big move is going to be your best opportunity cost. Sitting in a stock that's not moving at all, now you're losing all your opportunity costs. Once we start to piece together these patterns and see that they continue to set up in the market, we could start to use them with our moving averages. So when a stock starts to break the moving averages and it gets above, now we can come into the moving averages and make a big move up. Now, this gets me into the cycle of price action and how trends actually work within the market. And I want to explain exactly how the stocks move and how you can take advantage of these moves that end up happening. So the cycle of a stock usually looks something like this. You have a decline that happens down, and then a stock starts to bottom. This is called the bottoming phase. So off of this low, it'll make a move up. It'll actually undercut and take out this low right here, make a little bit of maybe an inverse head and shoulders, and then it will start to build a set of higher lows. So this is going to be at your first higher low, and then a break above, and then you have a retest of that higher low, a little bit of like a base here. This is also called an EMA crossback, and then boom, now you have your new uptrend that begins. Now, the most important part is understanding how the moving averages tie into this whole thing. Now, imagine this is going to be like the 50 EMA coming down here. This is why it's so important to use the moving averages. You can see when a stock is downtrending like this, the stock is making a big move down. It's rejecting the moving average, using that as resistance. When it starts to bottom, this is called our UNR. So our undercut and rally bottom. So you have a failed breakdown right here, and the stock or the setup or the index that you're trading is starting to bottom right here. And then you have your first higher low that is made. This is going to be your confirmation of the higher low. But the most important thing is the stock starts to reclaim the moving averages. And this is called our wedge pop. So the wedge pop basically means a stock got back above the 50 EMA and now it's trading above that spot. This is usually the first area you want to start buying a stock after a downtrend, because it's telling you that the downtrend might be over. Now, a lot of times what ends up happening is you have the initial wedge pop that plays out, and then a stock will come back down and retest the EMA that it broke over on the wedge pop. And this is called our EMA crossback. And sometimes this will set up within like a flag or a pattern like this. You'll be able to trade for a big breakout move to the upside. Now, this is usually my favorite spot to buy because you're buying into the moving averages. The only thing is sometimes, of course, a stock that is very strong coming off of the lows might just not really give you that EMA crossback and might continue a little bit higher. And then you don't want to chase it all the way up here. From there, you have your your spring move. This basically means this is where the new trend begins and you have the massive move up. Now, by the time this is established over here, this is probably already a little bit too late to get into the position, which is why it's so important to be watching for the wedge pop plus the EMA crossback. Sometimes you get a little bit of a retest of the EMA crossback or the wedge pop highs right here, which could be another entry that you could take. But once you're kind of on the right side of this rally right here, you might be a little bit too late to the move. All right, now I want to show you guys this in action. So you can see right here, you have a downtrend that begins. The stock starts to lose the 50 EMA, and then boom, you have your downtrend. It's holding the 8 EMA as resistance. Now right here is going to be our wedge pop. Notice how the stock breaks back above the 50 EMA and then kind of pushes off that spot. From there, we're going to have our EMA crossback. So notice how the stock ends up coming back into the moving averages, testing them and holding them as support and kind of building a little bit of that flag. And from there, we have our ignition move. So we have a massive move to the upside. And you could see since the wedge pop, we got a 86% move to the upside. Now, understanding this cycle will keep you from trading the worst stocks in the market that are below all the moving averages, that are not ready to make a big move up, and keep you in the best stocks. It'll keep you in the ones that are wedge popping, the ones that are making the EMA crossback, and the ones that are actually uptrending. Remember, the most important thing is to trade the trend. If the trend is to the downside, you want to be trading things to the downside and trading the market to the downside and shorting. If the market is above the moving averages, you never want to short, because what ends up happening is you get caught against the trend. The trend is your friend, and being able to utilize the trend is one of the most important things that I've learned over my career. Now, remember this one simple rule, and it's going to help you a ton in your trading. If a stock is under the 821 EMAs, you probably want to be shorting or looking for the downside, or just completely avoiding trading in the market. If a stock is above the 821 EMAs, it has a lot of momentum and it's probably going to continue higher. You can look to buy it off of those moving averages as long as it's within that trend and it has an active setup like the patterns that we talked about in this video. Now, I hope you guys enjoyed this video and learned a ton from it. This is only episode 3, so I can't wait for you guys to see episode 4. We're going to talk a little bit about volume and how to incorporate that within your trading, but make sure to study these patterns. Make sure to study how the market actually moves and how it maneuvers, and you'll be able to see exactly all the moves that are happening underneath and follow the trend to make massive returns.